Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
Glad you are with us today as we talk financial matters and help you make some sense of what's going on in the financial world. Actually, the short-term financial world is going to move its own course. What's going to relate to your success or not is the plans that you put in place today and that the plans that you maintain in spite of what goes on in the financial world.
You mean Bitcoin isn't an answer? Bitcoin is not a long-term financial answer?
The Securities Exchange Commission chairman said he didn't think it did exist long-term.
Well, you saw what China did.
What's interesting is Ecuador a couple weeks ago comes out and says now that it's going to be their national currency, whatever that means. The huge economy of Ecuador doing so great, that's why no one could. They're all heading north.
Well, Ecuador's national currency for years has been the U.S. dollar.
I'm sorry, El Salvador.
Okay,
not Ecuador. El Salvador.
Okay,
excuse me, I misspoke.
Yeah, I was wondering because I did.
El Salvador.
Well, El Salvador. Who cares?
That's my point. Okay.
The only reason they chose Bitcoin is because it's less volatile than their own currency. Which is which is funny. It's kind of sad, really. It's really sad. It's kind of sad that the country is.
They did this right when Bitcoin's like $50,000 a coin, and then China comes out and says,
"Not going to recognize it.
We're not going to allow our people to own it."
Yeah, it's interesting. So Bitcoin is not an answer. Your meme stock is not an answer.
Could be.
Your AMC. Was it AMC? American.
We're going to spend a little extra time on that. We're going to take some calls, but we're also going to spend a little extra time on the program today talking about some of the, first of all, volatility in the market and what that might mean. We'll spend a little time talking about some of these meme stocks, Robinhood.
Yeah, I'd like to dig into Robinhood and order flow and how they make money.
Yeah, so we'll spend a good chunk of the second part of our program today ducking kind of through some of those things because it is the craziest year from the financial markets. You look at the supply chain constraints and how is it that these?
Yep, and
I mean, you drive by the car lots; they're
empty. I hear ads wanting to buy used cars. I want to buy your used car. The used car salesman actually has a position in life now that they've only dreamed of.
They're not teased anymore. Oh, you're in used car sales. Well, that's very interesting.
You're sitting in the fabled catbird seat.
So no longer do you have to make up some other job title at Friday night cocktail hour. It's,
I'm in used cars.
That's funny. It is crazy times. Anyway, to join the program, love to take your call to be part of the program. 833-99-WORTH is the number. That's 833-99-WORTH. Numerically, it's 833-999-6784. And we'll take your call. And we'll start here in Kansas City talking to Owen. Owen, you're with Allworth's Money Matters.
Hi, Pat. Hi, Scott.
Hi, Owen.
Thanks for letting me call in.
Thank you.
Hey, real quick accolade to you guys. My guy retired that I used to listen to back in 2017, and I stumbled across you guys just a couple of years ago, and it's nice to have a trusted voice when it comes to personal finance. You guys do great.
Was that Bob Brinker?
It was.
Yeah.
He was great.
Yeah.
So anyway,
is he retired? Is he not? I haven't followed him in the last number of years.
So he did a Market Timer magazine that would follow. That still comes out, but as far as I know, he's not doing any radio or any public stuff. As far as I know, I guess.
Yeah. Anyway.
Yeah. So so it was great to find you guys. So I'll give you a little background here. I'm 56. Wife's 57. I got a son, second year in college, and I got a daughter that's in ninth grade. They call that high school for some reason, but it's Anyways, she's ninth grade. And here's my question. I've got a slug of money in an IRA, and I thought, well, geez, if my wife and I step off a curb, get hit by a bus, these two would inherit the IRA. And as of January 1, 2020, that's now a 10-year spend down that you're required to do, correct? So I'm thinking, gosh, how do I plan for that? I don't know if I can do Roth conversions to make it all go away, or do I do a GRAT, or do I just get a life insurance policy and hopefully have enough in the policy to cover the majority of the taxes for them to convert it into their own IRA?
And the reality is, the statistical chance of both you and your wife dying in the next decade are almost zero, right? I mean, statistically.
Yeah, correct.
So, and how much is in your IRA ballpark?
$4 million.
You do have a slug of money in your.
Good for you. So the things that you mentioned, like putting the money in so they can convert to a Roth, they can't convert to a Roth. A GRAT.
I meant me trying to convert in time.
Oh, yeah. What's your income?
$384.
Yeah, well, their income's not going to be $384, at least not for decades, right?
Yeah, so
Right.
so we're going to scratch that one as a non-starter.
Correct.
I mean, let's say you died. Let's say both you and your wife died today, right? So now we're talking $2 million each over 10 years. I'm doing simple math. We'll have some growth. Let's call it $200,000 a year of having to come out of this. A little more than that, but that's a lower tax bracket than you're in right now.
Correct.
So that's
your bet from a purely financial standpoint of reducing taxes on this, your best bet would be to die.
Yeah, which isn't
not a good option.
We're just gonna check that off as a non-starter.
Right.
Okay.
So then all options.
Then you talked about insurance, right? You're not. Typically, you'd buy insurance to actually replace
taxes,
an income or a tax, but this is underneath. There's no estate tax on this.
Unless, what's your overall estate between you and your wife? At everything.
8.
Okay.
Yeah. So even if we have the proposed changes in Congress, that you're still going to be,
you'll be under that limit. A granted annuity trust, which you said to GRAT.
Right.
I don't think you can give money from an
IRA in a GRAT.
The only money he can transfer directly would be his required minimum distribution directly to a charity at age 72. So that does.
Yeah, it wouldn't work. That wouldn't work. I think you shouldn't worry about it.
Okay.
That's what
I think a bigger worry is, should something happen to you and your wife, when do the kids get the dollars? What are the stipulations around that?
So I assume your trust actually is named the beneficiary of the IRA, and there's instructions in the trust as to how the dollars should be distributed out of the IRA and into the trust on behalf of the children.
Correct, but if they're older than 18, they are the beneficiaries of the trust.
Doesn't matter.
That's true. I guess it would be.
So, I mean, like for myself, I've got things set up in such a manner that should my wife and I die, I've got 4 kids ages from 11 through 25. I wouldn't want any of them to have the money right away, right? And so I've got it structured in such a way that money goes into a trust. They're not listed as a beneficiary on my IRAs. My wife's
Your wife is the primary,
and my trust is contingent. Correct. And then it creates a little more complexity, but then I don't want the kids to get all this money on their 18th birthday or the 25-year-old immediately. And I've got it set up such a manner so that I've got an independent trustee for until they're 45.
That would be me.
That would be you. And if it's not you, it's another one of another financial advisor that I know closely. But that way, there's someone who can kind of help these dollars be used for good and not used for
you don't
bad. I mean, I think we've all seen situations of people who've inherited a bunch of money or win the lottery or whatever it is, sudden wealth, and they tend to make poor choices.
Oh, I had a friend that when he was 18, he received a large settlement because he lost an eye in a BB gun accident, and between the time he turned 18 and the time we ran out of money at 20, when I say we. It was him and all our friends.
We're very popular. You haven't talked to him since, have you?
No. We had a blast. I'm not going to lie. He was great to hang out with. So the thing that you really need to focus on is the trust. And you want to name your wife as the primary beneficiary in the IRA, and the trust is the contingent.
Yeah, and if at some point in time you find yourself without as much in the way of taxable income, then maybe look at some conversion. But
Not
I
now.
wouldn't convert now at your high tax
I wouldn't
rate.
buy a life insurance
And I
policy.
wouldn't buy a life insurance for this particular purpose. There's a lot. Who knows what's going to happen between now and the time both you and your wife are going to pass away.
So does your trust stipulate things like we just spoke of?
It does, now that you guys bring it to my attention. And I guess I was just trying to find a shortcut to that, to those guys. But you're right. I guess that trust umbrella covers them in that incident. I did think about doing the Roth conversion, so I'll be selling my business next year, and then I'll have a 10-year payout, but that's probably still going to be too high to even mess with any
And
Roth
did
conversions.
when you said the $8 million, did you include the value of your business in that?
I did.
Okay. So
And did you, out of curiosity, did you accumulate this $4 million in just 401k assets, or did you have a other kind of pension plan as a small business owner?
like a profit sharing.
No, I haven't put a penny in since I started my own business. So I right after high school, I went in with a company, and I'd been with that company for 28 years. And I did a 401k with those guys. And when I left to start my own business 8 years ago, I opened up a self-directed IRA to roll those funds. I was going to do a Roth, but I thought, man, I haven't got any offset, and that'll be a big slug of taxes I got to, cover. So I just stubbed it into an IRA 8 years ago, and really the majority of that money's shown up over the past 8 or 9 years.
Good for you. Good for you. Good for you.
Yeah.
I would recommend that you pull out your living trust and read it again to see how those dollars and how you feel about it. I myself have 4 children, much like Scott Hansen. And my wife and I go through this practice about every 5 years, and we have changed the distributions as my children have aged, and either you watch them mature or lack of maturity. But fortunately, all 4 of mine have matured since we put the trust in place, and so we changed the payouts in the trust. Hopefully, it never comes to that. Hopefully by the time I pass away and my wife passes away, the kids will be old and gray. But who knows, right?
Can I ask you a really quick nuts and bolts question on a Roth?
Any question you'd like.
Okay, so if I had a traditional IRA and I was able to convert to a Roth, am I selling those assets, letting it settle, moving it to a Roth and rebuying, or am I moving shares from
You
an
can move
IRA?
shares.
You can without selling anything. It's just being relabeled, correct?
Yeah, but the reality is, in most accounts, it doesn't cost anything to buy or sell. So the idea of moving shares actually brings it through a hurdle that.
I don't know.
What do you mean?
What hurdle is it? You just
You have
transfer
to transfer the shares.
Why is that any more work than transferring a dollar amount? It's just
I guess it was an all or nothing.
it's zeros and ones in a ledger of some sort.
If it's all or nothing.
Either way. You have 200 shares of IBM and you transfer 100
and then 100 in cash.
Whatever. It doesn't matter. You can.
The answer is yes.
Yeah.
Whether you should or not, Scott and I will disagree on.
But you could transfer shares of a privately held business.
Most certainly.
Although with changes in Congress, that might, if some of this legislation goes through, that might not be the case.
I would rather transfer the shares as volatile as this market is.
Okay. Then transfer the shares.
Okay. I just didn't know if that was a thing.
That
or if you
certainly
had to
is a
actually
thing.
Sell the asset and then stick it in another bucket and relabel it. Okay.
Oh, and you've done really well with your financial planning here, and the challenge with these retirement accounts, that tax is going to be paid one day. The way it is now, you'd be better off with your heirs paying taxes. And who knows? By the time you pass on, you might have grandkids that you might list for a portion. You might have, you can set up a separate trust just for your retirement accounts that have some additional beneficiaries on that to be able to spread the taxation. So you've got some other flexibility. You'll have more flexibility as time goes on. There'll also be some different changes in the tax law. But with income at the high as it is right now, we would certainly not recommend any sort of Roth conversion. But appreciate the call. Let's continue with calls to be part of Allworth's Money Matters. 833-99 Worth will get you onto our program. And we are talking with Terry. Terry, you're with Allworth's Money Matters.
Hi, how are you?
Hi, Terry.
Hi.
How can we help?
Well, I would like some advice. I have a Roth. I'm 61 years old. I don't work, and my husband is 61 also, and is still working and plans on working for the next 5 to 7 years. I have a small Roth, about 85,000, and so my thoughts were, next year is our 40th anniversary, and we want to go to Europe and start taking some really nice trips. And
good for you.
I thought, while he's still working, cash out my Roth and use that to travel on for the next 3 to 5 years, and won't affect our income. Just looking for some advice.
As a general rule of thumb, I like to say the Roth dollars are the last dollars we spend. But having said that, you save these dollars for a particular purpose. I love the concept of you guys are in your early 60s. Like, we never know what tomorrow brings. Let's plan. Right. This is something that's important to us, something we'd like to do, something we'd find fulfilling. Let's do this. I think that's prudent. That's wise. So what else do you have as far as financial assets?
Well, my husband has a 401, a little bit over 800,000.
And do you have any money in a brokerage account, any mutual funds or stocks you've owned for a number of years or something like that?
Savings accounts?
Savings, yes.
How much do you have in savings?
About 20,000, but yeah. About 20.
Is your house paid for?
Almost. I have a second mortgage, and it's less than 20,000.
And you're 61?
Yes.
When will that house be paid off?
In about 2 years.
Yeah, but don't wait 2 years.
Yeah, just take the money out of savings right now and pay it off.
It's so low.
I know, but the money you're earning in the bank is zero.
I mean, don't wait 2 years to travel.
I said don't wait 2 years to pay off the house.
With clarity.
Okay.
I'd pay it off as soon as I possibly can. What's the family income right now?
About 165 to 180, depending on bonus.
And how much longer is he going to work?
He's definitely working at least 5 more years.
And how much do you make?
She doesn't work.
I don't. I babysit my grandkids.
Good for you.
I was always a part-time worker. I didn't really get into I did not get into a 401k. So about 15 years ago, our financial advisor advised me to open up the Roth.
And that's great. You've got the money saved in the Roth. What was your husband's income 5 years ago? Has it always been kind of in this level?
Yes.
And will he have any sort of pension at retirement?
He has 2 pensions from a former buyoff. He was with the company for 41 years, and so it's been sold. So he's got 2 small pensions.
What's his earned income? What's he make at his job now?
165.
Okay. And then you've got these other pensions. So why can't you fund your European vacations out of your current income?
I can, but I was just wondering, why not spend it?
Oh, no. In fact, I would go exactly. I have a different view of Scott Hansen. I think you need some financial planning. You're going to have a hard time replacing your husband's income.
I totally agree with that. So you're not disagreeing with me. I mean, that's my concern. That's why I don't want these.
Yeah, the Roth dollars.
Retirement dollars should be safe for retirement.
Mm-hmm.
Right now.
Right.
If your income was a lot less, then it'd be hard to pull off the vacation. But like, I don't know why, if your home's almost paid off, you only owe $20,000, why you can't afford to pay for your travel out of your income.
Right.
You should be able to.
Yes.
You
might not be staying at the Ritz-Carlton,
but you won't be sleeping in a van down by the river either.
That's right. You can have very fine accommodation.
Right. So you should not use the Roth IRA money. You shouldn't use any IRA You should use none of that. You should actually increase your contributions towards your retirement plans between now and the 5 years that your husband plans on retiring.
Yeah, I do put in my maximum.
I understand. You should increase it above the maximum. The maximum is what is set by, well, you can save it outside of an IRA.
Okay.
You're allowed to save money outside of an IRA.
Yeah, I think the most important thing, Terry, if I were you, if you were my sister, I'd say, Terry, you and your husband should sit down with a financial advisor and do a retirement plan to make sure that that retirement is a possibility for you here.
If you were my sister-in-law and brother-in-law, I would pay for that financial plan. You know why?
Okay.
Because you own a financial advisory firm, and it'd be easy for you to do.
And that's what I recommended to them.
Okay.
They did the financial plan, but they didn't require me to pay for it. But I feel so strongly about it that where you're at in your situation, you're 5 years away from retirement. You've got a couple goals that you want to cover between now and then in terms of traveling.
Yep.
You can do that, but you're going to have a plan.
Right.
And we don't necessarily
That's
mean
what I needed. I needed some advice. So everybody I asked, they said, go for it.
yes, yes, and you can go. You can afford to go to Europe, but you shouldn't neglect. Don't use the Roth IRA, and you shouldn't neglect doing some financial plan. You should be saving more money than the maximum that the 401k allows. And you say, well, how could you do that? It's perfectly okay to save money in an after-tax basis.
But the most important thing at this point is having a plan so you see, like, if you don't do anything, here's what that means 5 or 6 years out when your husband quit working. And if you do these 3 steps, here's what that can mean to you. And then you can make the choice at that point, and then you could have some confidence and feel fine about going on the European vacation and realizing why staying at the Best Western is going to yield a much better retirement for you down the road than staying at the Ritz-Carlton. Not that it's, you know, I mean, if you have the money to stay at the Ritz-Carlton, fine, stay at the Ritz-Carlton. But if you having the right kind of spending plan for your vacation, I think is going to be determined by your retirement plan.
Mm-hmm.
All righty.
Okay.
All right. Appreciate the call.
Thank you.
Wish you well. And Pat, I'll never forget when my first year or two in the business, introduced to this couple. It was second marriage because he had been widowed. And he was talking about he and his wife. He was an executive at Chevron or something like that. I think Chevron. He and his wife had always talked about travel, and they want to travel together. And it was always, well, let's wait till next year. And so he finally retires. And their very first trip, they're flying from here to New York, and they're going to take the next plane. And she gets sick on the flight. Something comes down with something. Never left the United States. Ended up passing away 4 months later.
Oh, how sad.
Yeah, and I'm bringing this up just because the financial planning, it's a bit of a balance, right? Because we've all experienced, this is just my first experience in something like this, but we've all, as financial advisors, we see this time and time again.
All the time.
None of us gets out of here alive. At some point in time, we're going to die. We all hope we're going to live to past a normal life expectancy, but the reality is that doesn't always happen. We have a health issue comes up, we can't travel, one of us passes away or whatever. So my point is that financial planning, it's really the balance of what are those things that are important to us that we'd like to do during our life, and can we fit those in today without sacrificing our financial security tomorrow?
And your point, it was well taken, is it doesn't have to be, it could be Europe, but it doesn't have to be at the nicest hotel in Paris. It can be at a mid or low-priced hotel in Paris, and you can still get to see Paris.
And the benefit of the financial planning is you can see, what does that cost? What does that mean to me? What's the difference? Like, how's that going to impact my life? Because sometimes it's just money in an account. Like, what's that mean? Like, I've got all these dollars I've saved in my 401k. I've got $1 million in my 401k. Well, what does that mean? That seems like a lot of money.
Is that a lot?
Is that a lot of money or a little bit of money? Well, you do the kind of planning and saying, well, if you want to live high on the hog every week, it's not going to last that long. But doing the planning, you can see what the true cost is. What's that going to mean in your income in the future? What's that going to mean of any sort of inheritance you want to leave your kids or whatever those other things that are important to you in your life?
Exactly.
That was my.
But I like the best part of what you just said was the term you used, high on the hog. So
I don't even know what that means.
You know what it means?
No.
It means that the better the cut of the meat or higher up on the hog, the closer to the hoof, the worse the cut of meat historically has been. So if you worked for the landowner, you would not get the select cuts of meat off the pig, higher on the hog, lower on the hog.
Is it the same way with a cow? Like, what are the best cuts of beef? I remember being at a Brazilian steakhouse where they had like all the different pictures of where the cow is. And they bring the lower portion, the cheaper ones first. They try to get you filled up on that. And then
You figured out their scam.
oh, they first had the salad bar. Massive.
We're not eating any of that.
Give me the.
I came in here for cholesterol. I'm getting
I'm
cholesterol.
high on the hog here.
Anyway,
High of, I don't know.
I don't know what it is to beef or not, but I know that's where the term.
If you know, please don't contact us. Let us know. I really don't care.
We don't care. We're just trying to kill.
I could go to Brazilian steakhouse tonight, and I could see they'll have the little picture in front of me, and I could point to the area of the cow. Give me that cut, please, and they'll bring it out on this thing and cut it in front
We're
of me.
just trying to kill.
And I'll be so stuffed the rest of the night. And anyway.
When was the last time you went to a Brazilian steakhouse?
It's been years because I ate too much last time. This is Allworth Money Matters. We'll be right back.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McClain.
We thought we'd spend the second half of this program talking about just some of the latest things in the financial world. Talk about the housing market, talk about the stock market, options, interest rates, Robinhood, etc. And just have some open discussion on this because it is the Fed lowered interest rates. If you think back,
Which time?
okay. So they were lowered in the financial crisis, and we did this quantitative easing where the Fed was going out and buying bonds to keep interest rates low. We began that in the financial crisis
Of 2000, when did this start?
7.
Okay.
I don't know when we started. I think we
2008?
started doing the buying in 2000. 2008, 2009. I think we started doing the buying in 2009. That might have been the turning point. But we never quite
Never eased up.
Yeah, never got rid of the balance sheet, the stuff that they crammed in there.
Yeah.
And then when COVID started, if we think back, it wasn't that long ago when the markets were falling, we'd see the S&P fall over 30%.
In a relatively short period
Yeah,
of time.
just a few weeks. I
Yeah.
mean, it was if you think back, it was pretty quick how the decline was. And
And the recovery was so fast.
in some ways, Pat, I think it set false expectations because usually the average bear market, if you go back to 1945 or whatnot, last study I looked at, the average bear market lasts 9 months. So you have 9 months of declines. Not everyday declines, but
What defines a bear market?
a decline of 20% or more. We've
From-
had like
from the
12 or
top.
13 of them since World War II.
From the top.
Yes. They tend to last a long time. And it's not the short-term things are kind of easy to live through because it's
You
over
barely
before-
notice them. You don't have time to emotionally absorb
Yeah, you're
the
getting
loss.
sick about it. You're talking to your spouse, your friends about it or whatever. But the next thing you know, it last year, like popped back up. Normally not like that. And if you think back to the downturn we had after the dot-com bubble, it went from March of 2000 to November of 2002.
It dragged on.
2.5 years, like
on.
31 months, something like that. It just
On.
kept going on. It was very painful because after a while you're thinking this is never going to end.
So they
But-
lower interest rates, and then they eased long-term interest rates, which had never been done before.
The financial crisis, and then they used the playbook even more so.
Well,
It's
every
not-
time they started tapering or selling back bonds in the markets, there was a little bit of an uproar from Wall Street. Wall Street loves cheap money,
Of course they do.
right? For two reasons. One, it makes their asset class look more attractive. And two, companies that you buy stocks in borrow money as well. It's called leverage, and they borrow money as well. If the cost of borrowing comes down, then they can actually drive more profits. There's a spread there.
And the lower the rates, the more things get driven up in value. And the one easy way to see that is on interest rates with mortgages. So the other day, I just was, for the heck of it, I started running some numbers on my HP 12C calculator. That
Because you grew up in the 80s.
actually, I use the app on my my phone now.
But they have the old HP.
I've got one in my office here. I've got one at home too.
I know, but you can get the apps on the phones that actually mimic the.
That's what I use.
Oh, you do, the 30-year-old calculator.
Correct. Maybe more than 30 years,
Yeah.
but
That's
it's
all
a little
right. Still
backwards. It
works.
works perfect for me. So
The calculator itself doesn't determine the net present value. The calculation does.
okay, but without the I don't remember how to use the formulas anymore. I studied finance, and when this was in the 80s, I chose not to use a financial calculator, although we had financial calculators back then. The abacus. No, it was I chose to memorize all the formulas. I wanted to be able to actually do the math.
Yeah.
And so I memorized all the formulas. And it's like 10 years later, for whatever reason, I had an old finance book, and I pull it out, and I look at this formula. I'm like, what the heck is that? What is that big backwards E? It's funny how if you don't use something.
You don't use it?
I had no idea how to, it was Greek to me at that time. And now I just use my financial calculator. But my point is this. On interest rates and housing. So a $400,000 mortgage at an 8% interest rate, which wasn't that many years ago, your payment was $2,900 a month and some change. That same $400,000
That's
mortgage.
a 30-year fixed rate at 8%.
That's right. That same $400,000 at 4%, $1,900 a month. Today, rates are what, about 2.5%?
Yep, sub 3.
About $1,600 a month.
No wonder.
So 25 years ago, rates were 8%. That $2,900 a month at $400,000 was at 8%. That would pay off a $400,000 mortgage at 30 years. That same payment today will fund a $740,000 mortgage, almost double.
Which is what has happened. Which is what has driven asset prices in residential and, by the way,
Everything else.
some commercial real estate,
And
equities,
and because money's so cheap. And you can see how the debt service, if you're willing to pay X dollars, if you're a company willing to fund X dollars a month for debt service, and suddenly interest rates get cheaper and cheaper, you're like, heck.
Yeah, that's why you never hear about variable rate mortgages anymore, because the difference between a long-term interest
You'd
rate
be a
and
fool to
short-term
take a
interest
variable.
rate, right?
Matter of fact, if you have a variable rate mortgage, go refinance that today.
If you have a variable rate mortgage, where have you been for the last 10 years? You shouldn't have a variable rate mortgage. You should have gotten rid of it long time ago.
People probably haven't. But that's what's driving the stock market. I mean, the housing market. And then, of course, short term, it's been,
So what happens when interest rates go up?
well, who knows?
Well, we would expect. You would expect.
And there is the conundrum.
You'd expect. I had
So
the-
now we see inflation, which was transitory, and now the transitory is going to last a little longer. I never heard the term transitory. Transitory is going to last a little longer than we had expected. Don't worry, this is short term. Once the supply chain works its way through.
Well, this is what we're hearing from the Federal Reserve.
That's right.
About inflation.
Because typically, what the Federal Reserve needs to do when there's inflation is they raise interest rates to cool things off a bit.
To slow down the economy, because there's a fine line between deflation and inflation.
That's right.
Right? And you want it to be somewhere in the sub 3%. You'd prefer it 2% inflation. You don't want zero inflation. You don't certainly want negative or deflation, but you don't want 6 or 7% inflation either.
So they're in this challenge now. Well, if we slow down our bond purchasing too quickly, or quit buying them at all, or start selling off some of our inventory, or if we raise interest rates, our short-term interest rates, the things that we can control, what's this going to do?
Scott, do you not
to the overall economy and to asset prices.
Do you not think that the Federal Reserve has actually moved away from what used to be controlling the economy now to controlling asset prices over the last 20 years? Didn't they just let the asset prices land where they would?
They used to.
And worry about the economy? Isn't that what the Federal Reserve was designed to do, is to help regulate,
have you paid attention to how far off they've moved from some of those issues?
Oh, 100%.
Now there's climate issues,
Right?
DEI, all that. The Federal Reserve.
DEI.
Diversity, equity, inclusion.
Oh, I saw that.
Pat, you should know that.
Well, I know it.
Come on.
Okay.
Where are you? It's 2021, for crying out loud.
Okay, diversity. I get them mixed up. ESG, impact investing. Right. Whatever. You got to remember, I live, my daughter, who is, she's at.
Oh, here it is. Anytime there's a diversity equity, we all try to, all the white guys try to find, oh no, not me.
Because I got a kid. I have a kid. No. I wasn't going to say that. I was going to say she accuses me of this sort of stuff all the
does
time.
she?
Oh, yeah, absolutely.
Well, she teaches at an inner city school. Can you
She
say
does.
inner city?
I don't
Can you
know.
say
It's not
impoverished?
inner city. It's
Okay, then not.
It's not inner city, but it is in a definitely economically challenged area.
Economically, yeah.
Yeah, economically challenged, job challenged, food challenged, crime challenged,
Poverty.
educationally
High
challenged, high poverty area. But when I had tried to have conversations,
And she's a little liberal too.
oh, 100%.
Okay.
I mean, statistically, it was going to happen. I had 4 kids. But she challenges me all the time on those sort of statements, which is like, don't think like that. And she's probably right. But, so what was it, DEI?
Yeah, no, forget about that, because
Okay.
right now we're getting an area that we don't want to go in this program. But the Federal Reserve, they have many mandates now.
Their charter has changed.
There's no question about it. And so we've seen volatility return to the stock market, particularly the month of September. Right? It's like what felt like this nice, slow, steady increase in 2021. Suddenly we've got some volatility. And who knows where we'll finish the year.
But I welcome the volatility. Did you not?
Of course I do.
Right?
I'd like to see it. This might sound strange. I'd like to see a 20% decline in the stock market.
At least for a period of time. And why would you say that, being an investment advisor?
Because investments are based not just on the investment, but the investor as well. And when people get complacent and they don't see the risk that's in their portfolio, they oftentimes will take on more risk without understanding the risk that they're taking. And then when the downturn occurs, they're surprised by it, and they make reactions based upon their emotions. And they took what would have been a temporary decline and made a permanent destruction in their retirement savings as a result.
Because they didn't understand the risk to begin with. Because there wasn't a shock in the market.
And how the financial markets work.
Reminded them that there is risk.
Oh, yeah, this does go down.
Yes, there is risk. There is risk.
And that's the challenge, I think, when you go too long without having a downturn. But I find it amazing. I think most of us are... no one would have guessed at the start of the pandemic that the stock market would be up 30-some-odd% from beforehand, right? It's just
crazy. Just crazy.
And now, when you look at some of the things you look at the supply chain imbalances, the shipping containers off the port of Los Angeles and Long Beach, where it's multiple issues, right? So when you put everything on pause, send everyone unemployment checks and stuff, now they don't have the truck drivers that they need. The rules of how many hours someone can drive means that they may not have enough time to bring an empty truck back to get another container box. I mean, it just compounds on itself. And then when we look at parts of the world, China's got areas where they've shut down the factories because of COVID. And then I don't know if you've been following some of the energy crisis that China's in, and Europe.
Oh, in Europe, absolutely.
Natural gas prices are up, what, 4 or 5-fold from where they were a year ago?
Just due to supply chain disruptions.
That and they've all these shut down all the coal plants, going to rely on wind and solar, and suddenly the wind doesn't come for a while, and then you're trying to end up buying natural gas
On the spot market.
coal, dirty coal from someone to. It's just amazing, and yet the
market goes and goes and goes.
Yeah, it's bizarre.
But I quite frankly, I think a large part of it is actually just is due to the fact that there's so much cash washing around for the average consumer.
And investing, I mean,
they're investing some of it.
The amount of money going to venture capital, all-time high. The amount of money going into private equity.
Well, but I think one of the reasons that that's happening is because the private equity and venture capital don't have the same regulations that you do on a publicly traded stock.
So companies aren't going public anymore.
So companies don't go public anymore.
I mean, relatively.
Yeah. I have a friend that took a company public. If it was 20 years ago, Allworth would be a publicly traded company.
Yeah, good chance
we were
for that.
cap
25 years ago. Yeah.
Okay.
Whatever the not the Dodd-Frank was the precursor to that one. Anyway, Sarbanes-Oxley.
Yes. And so now there's different ways to raise assets, capital in the marketplace.
SPACs.
Okay. Special purpose acquisition companies. My favorite. The ripoff of the year is the SPAC.
Not that all SPACs are bad.
That is correct.
A special acquisition company. It's essentially a financial tool that people have been using.
Where they go out and raise money without telling you what they're going to do with it. And then they say, trust me, we're going to go get something really, really good. Just give us this money. Just give us this money. And then they go out and acquire the companies. But the reality is, if you look at, and these are relatively, well, they've been around for years. They just haven't been popular. They've been around for years. And it is a methodology in order to go around regulations on how to raise capital.
To go public.
Which is very similar to what we just talked about private equity and venture capital. It's because that is a different means of companies to get to a capital market that doesn't require as much regulation. And the special purpose acquisition company does exactly the same thing.
So the way they're set up, they go out and they raise money. They raise tens of millions of dollars. Then they go out and find something to buy. Right? They'll go out and find something to buy, typically a private company, sometimes a public company, but typically a private company. They'll go out and buy this private company, fold it in. Now it's part of this publicly traded SPAC. But there's some challenges with that. One, I don't know if you paid attention to this, Pat, the ones that there are some that they're trading for less than the original investors, and it allows the investors to pull their money back out.
When you say the original investor, less than the sponsors.
Someone puts it's valued at $10 a share, let's say.
Yes.
You put in a bunch of money, suddenly it's trading for less than $10 a share. As an investor, you have the option to get your $10 back.
I wasn't aware of that.
Now, in reality, it shouldn't operate this way when you've got a publicly traded company and there's the cash sitting there.
Yeah, you shouldn't have first right at.
But
it's not a loan.
But there's some options. So some of the trading that's been going on in the options market, sometimes I've pushed some of these the prices down of these SPACs to where someone as an investor saying, I don't know what the future holds, but I'm not quite that confident in these people anymore. I put in $100,000. I have an opportunity to get $990,000 back today. Maybe I'll just take my original deposit back.
Yes, easy enough.
So we're seeing that on some of them, and they're starting to implode.
Which depresses the share prices of everyone else left behind.
Starting to implode. But then we're also on the other end. We see things like this headline. I thought Leonardo DiCaprio backed pollster valued at $20 billion in a SPAC deal.
He was excellent in Pirates of the Caribbean.
I don't think that was him, was he?
I don't know.
He was.
Am I wrong?
Yeah, you're wrong. He was in Titanic.
I got
Isn't that Titanic?
I got my C.
He's a
movie.
great actor.
I got my C movies. Movies
I don't
about
know.
the sea.
I don't know what makes him a great business person, but like, I don't know many people would hire me for acting.
Wasn't he in Catch Me If You Can? All right.
Okay, then maybe it is worth $20 billion. He was fantastic in that
Catch Me
movie.
If You Can when he portrayed someone that was pulling scams.
I don't think I saw that.
When he was a pilot, he dressed as a pilot, went around writing bad checks all over the.
Oh, I never did
US.
see
Oh,
that.
it was an excellent movie.
Oh, really?
Yeah,
Maybe
I
I'll watch
enjoyed it. I
this
enjoyed
weekend.
it. It was every bit as good as
exciting,
Office Space.
Office Space. That's one of those more times you watch. The first time I watched it, I wasn't very entertained.
We were on vacation a couple of weeks ago. I was with
was?
my brother, and we were in Southern Oregon bicycle riding. We went up there for a week to go bicycle riding. It was so smoky, we rode 3 hours. But we watched Office Space
There
a
you
couple
go.
times.
A couple times. You can't watch it a couple times. It's pretty slow.
We did watch it, though.
So look, this one might be a fine deal or not.
Well, it's got Volvo involved.
So it must be. It's safe.
Well, that doesn't mean anything, by the way.
When you get
When all of a sudden, when they start putting celebrities all over these things, these SPACs, in order to make them more exciting, more marketable, you're just like, I don't know.
there'll be some successes, but there'll be many
Colossal
people
failures.
very disappointed.
Colossal failures. And don't think that institutional investors don't make mistakes either. Look at all the people that
Oh my gosh,
invested in Theranos.
that's an interesting trial.
Yeah, think of all the people that invested in.
Smart.
And if you read the book or watch the movie Bad Blood, excellent. If you're following
Is
this
there a
trial.
movie on that?
Yeah, there's a movie called Bad Blood as well.
Oh, I
and
should watch it. The book was fantastic.
it was excellent. So don't think that just because they're institutional investors that they can do no wrong. Just look at some of the people that invested in Theranos.
Speaking of investing, Robin Hood. Well, didn't Robin Hood steal from the rich and give to the poor?
In the Sherwood Forest.
I have a feeling that modern day Robin Hood is going to be a wealth transfer from young and those with little assets to those with
Lots of assets.
lots of assets.
So you know what bothers me most about Robinhood? Do you want to talk about
Robinhood is an online trading company.
Yes.
Their whole thing is we're going to democratize investing
/ gamify.
and gamify, big time gamify. Their whole app's designed just like a game. It's almost the same kind of tricks that casinos would use to get you to invest.
So they don't charge commissions or fees.
It's free.
It's free.
Yeah,
Oh, they-
trading's
they-
free.
So how do they make money?
They make money by directing your trade to somebody else that would be happy to make the trade for you because it gives them a chance to get ahead and they could of other trades and they can make just a little tiny bit of a share spread,
And
price spread.
the people that execute the trade pay a rebate or a commission called deal flow. And so what happens is these firms are supposed to do best execution
Get the best possible price possible.
for the person that is making the trade. And so when you make a trade, let's say I buy 100 shares of, just let's go old school, Intel.
Okay.
The firm does not every 100 shares actually gets traded on the New York Stock Exchange.
Most
like
do
you
not
see.
get
Most.
exchanged.
What happens are most actually are routed through what's called a broker dealer. And a broker will actually bring it and broker it outside, but a dealer deals out of its own inventory. So I go to sell 100 shares of Intel. They're like, this 100 shares of Intel, this is a pretty small trade. I've got 1,000 shares of Intel sitting on my shelf in here. I'm just going to buy that 100 shares that Pat McLean is selling and put it on my shelf, knowing that someone else is going to buy some Intel later on in the day and that it's going to work out at the end of the day. That's the dealer side of the broker-dealer. The pricing on that stuff is really hard to determine. And that's where the little bit of spread in there actually goes
That's
back
where
to Robinhood.
gets a lot of their That and from the options.
And the option trading is where they make most of their money, and on little cash balances that stay in the account. What's amazing to me is that
They've got like 22 million account holders.
My kids trade on Robinhood all the time. They do the meme stocks. My nephew does too. Oh, absolutely. They do options too. They do it.
We all know how this game ends.
Oh, they try to talk to me about it. I'm like, okay, it sounds great now. Wait. Just wait, kids.
Well, options are a zero-sum game. At least if Intel does well over time, we can all benefit.
They say when you're doing options, you have to be on the Reddit the whole time watching, and when they quit talking positive is when you dump. He said the tastemakers are the ones that determine the price of the stock, and they'll never actually come out and say anything.
Here's my challenge with this. Robinhood's going to college campuses, buying kids free cups of coffee, get them to open an account, trying to get everyone to open an account. This is not investing.
Much like credit card companies did 20 and 30 years ago.
It's not investing, it's speculating. That's fine. Look, we've got clients that have millions of dollars invested, and they have side accounts where they do a little speculating and they enjoy.
Not unusual.
I get it. But you're not going to build wealth by trading.
But Scott, why the securities industry hasn't? Well, actually, they're starting to come after Robinhood.
They've
now.
had a couple big fines.
Yeah, they have.
Just like the way we saw Uber ignore the rules until they just pay the fines. All these other disrupting companies, Robinhood did the same thing. They ignored all the securities rules that have been on the books for years and just went full steam ahead, thinking, well, we'll build the business and just pay the fines later, which is what they did. I don't have a lot of respect. I got to be honest with you. I don't have a lot of respect for Robinhood. Because I don't think what they're doing is actually helping people. If they want to say this is just for sport, great. I don't have any problem. You want to bet on sports, great. Do whatever you want. But to make it sound like this is investing?
It's not investing.
It's not investing. Anyway, we're almost out of time. Hey, wanted to let everyone know that we've got a special 3-hour call-a-thon. Is it a call-a-thon? I don't know what everyone call it.
Call-a-thon.
It's a call-a-thon. Pat and I, myself, are both going to be in the studio for 3 hours taking your calls regarding your financial questions. Monday, October the 11th from 4 to 7 Pacific time. Okay? Monday, October 11th, 4 to 7 Pacific. That's 7 to 10 Eastern, if you can't do the 3-hour math difference yourself. And to be part of the program, if you want to call, all you got to do is during that hour, call 833-999-6784. 833-999-6784. Call that between those hours of 4 to 7 Pacific, October 11th. We'll take your call then. All right? Enjoy the rest of your day, rest of your weekend. Glad you've been with us. This has been Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.